Tuomas. How are you? Welcome back.
Hi, I'm fine, thanks. Yeah, that was a well,
Shocker number.
kind of
Yep.
yeah, not to us basically, but yeah, it was a shock kind of. Was the I haven't had time to look at the revision. Was the revision for the Q1 even lower? Was it
Yeah.
minus 1.3? Yeah, okay.
Yeah. Yeah.
Well, congratulations, you are in a recession now then.
Yeah. Well, things are good. It's the best of times and the worst of times. So,
Yeah, yeah, that's true.
I'm looking at these numbers and wondering what you're thinking here. Gold took a pretty big hit. It's trying to recover here. Same with silver. I know that last time we talked, you liked gold and farmland, and that was it. So, did you bring anything to share today, buddy?
Yeah, I have some graphs. We can continue that, but few
Oh,
words about the gold. We have a like long position on gold. Like now, not we don't have it, but we are proposing like let's say a 3-year position now.
okay,
So it's
3 years.
not it's true the recession and crisis. But I think
Yeah,
we can continue on few. I made few slides just to I think this will be fine on the.
and I was thinking about you when the spreads blew out uh, between Italian bonds and the rest
Yeah,
of Europe,
yeah.
and
And
I
now
know
the, now
that
the, now the ECB is trying to get it together with the TPI, it was transition protection. I don't. Yeah, it's a strange concept. We haven't had really like time to look at it yet. But yeah, we're in trouble basically, all of us, I guess.
yeah, nowhere to hide, right?
Yeah, well, very little places to hide. Like just the gold, physical gold for just hold it for next 2 3 years and see what it gives. And
Okay,
the whole idea of that is that if this gets so bad as we think, then you have some liquid assets, so you can buy those highly depressed assets at the near the bottom. That's the whole point
right.
on
Okay,
gold. So you secure your liquid position. Whatever happens to the markets, gold will still trade, or if it doesn't trade, then we're in a stone age, and who cares at that point.
yeah. Then you need guns.
Yeah, yeah, guns and ammo and
Yeah,
farmland.
and a getaway. Yeah, then go to your farm.
Yeah, yeah.
So, what do you think
Good.
about what the ECB did last week?
Well, I don't think it did much, but
Yeah,
it's if you think about just raising it by ending the like negative rates for how long they was in place from June 2014, so 8 years
okay.
negative rates.
Okay,
And
so
and
we're
I
looking.
have the and if you look at the can you see this?
Yeah,
What
the
I yeah
consumer credit as a
yeah
share.
yeah, but this
Uh,
this is the inflation rate in the eurozone
okay,
throughout the whole existence of euro.
okay,
So we are now at 8.6 in June,
okay. And
and
that
and our rates
consumer,
are, and our rates are zero.
pretty much, yeah.
That doesn't
So
make any
a
sense.
little bit
Any
behind the
sense?
curve, are you saying?
A bit, yeah, like a record amount. But
Okay,
but the thing is that the ECB has changed from there's only one thing in its mandate, and it's price stability. And it has nothing. The ECB has nothing to do with price stability anymore. It's about conserving the eurozone. Through QE or
yeah,
buying enough Italian bonds so the yields don't break away. That has
okay.
been its only mandate for the last 2 to 3 years.
To save the monetary union
Yes.
because the fiscal union isn't working
Yeah,
because there
fiscal
isn't
union.
one.
Yeah, isn't working, and it's a fiscal union would be a very bad idea.
Okay, so your last chart is interesting. Previous chart,
Yeah.
consumer credit chart. So people in Europe are
No,
living
this
off
is
their
this is
credit
this is the
cards.
U.S. This is the U.S.
Okay, so we're living off our credit cards here.
Yeah, you are living and you are at the record levels of share of
Wow.
consumer credit. Yeah, and if you think the situation now with the GDP print, so you don't the consumer doesn't have the funds when the interest rates rise. They don't have the funds to keep the economy going at the same speed. No way. They will cut back because it will hit like if you have like This is the first time in history that the share of consumer credit as a real disposable income has gone beyond 30%.
Okay.
So
You know, there is spillover already happening in the car market that during COVID, car dealers, because people were getting $4,000 a month for the government, they didn't back check income or anything, and they were valuing the autos at 130%, and people had $800,000-$900,000 car payments that they could pay then, but now they don't have that stream of free money, and rates have gone up and food prices have gone up. So there's there's a storm of repos happening in the car market.
Yeah, that's what I hear. The default rates are really high, and it's like the same in the housing market in 2009.
I think it's only $1 trillion.
Yeah, only $1 trillion. Yeah.
Well, what was the housing? I have no idea what it was.
I think it was about the dam. It was 20
trillion.
Yeah, not 20 trillion. I don't remember it now. But
1 trillion is a big number for the banks to deal with.
Yeah. Like GDP is something in the range of 20 trillion. So yeah.
Okay. So it's 1/20th the size.
Yeah. And that is a big hit because that have repercussions, you know, on all consumption. That's the thing here. Everybody owns a car, like everybody owns a house. Everybody owns a car, so it will have repercussions. You know, it will spread.
Right.
There was actually another surprise which went quite unnoticed, that the service PMI, the Purchasing Manager Index in the US, was below 50 this month.
Okay.
It was 49.3, implying that the service sector is already in contraction. And this all comes out to the fact that the Fed is raising rates, and you know the consumers have so much debt.
You think that, and do you believe that Paul has shifted into neutral?
No.
As of his statement yesterday.
No, absolutely not. I think they are just looking what the data says. They have a next meeting in September. They are just leaving the doors open. Of course, they are afraid that they will push the economy in the recession, which I think it's inevitable, because you have if we disregard the artificial recession in 2020 between February and April, when the economy was just shut down forcefully, or it was forced to shut down. If you take that away, you have by far the longest expansion in the history of the United States.
Of mankind.
You need to have recessions at time to time. It's just how economies work. They go in cycles.
Right. So we've avoided or shortened every one of them through central planning. We never really went through one.
Yeah. For since 2008.
09. Yeah.
08, 09. Yeah.
And we didn't really let that happen either. There were so many bailouts, so that didn't really run its course. That was interfered with as well. To shorten, right?
Yeah, that's true. And but another thing which you need to look out for is the you see the new QT has begun chart. I hope.
Yeah.
You see it? Yeah. So this is the first drop in this is actually from the Fed database of the St. Louis Fed. So the yield of U.S. Treasuries peaked at around 5,771 billion in June 8th, and now it has declined to 5,733. So the quantitative tightening has started. Okay. That has begun. However, the balance sheet of the Federal Reserve has dropped only, marginally, and this is interesting. I talked with some former Fed insiders, and they said that this is because there's a maturity covering happening in the mortgage-backed securities (MBS) in the balance sheet of Fed, but this will start to drop more heavily in the coming months. And the thing is that for the asset markets, it's not good news, especially when you combine with the recession. So here are the black lines. Here is first of all, this is the balance sheet of the Fed from the January 2018 till I just drew a forecast until the May 2024, and the black bars here are market crashes. So there's a 2018, 2019 crash, then there's the repo market blowout in 2019, and then there's the corona shock. And if you notice that there was a very marginal decline in the balance sheet of the Fed when these markets crashed. And if you compare to this forecast, which is what the Fed expects to do, this is much steeper. And combine this with a recession, which has now effectively started in the US. What do you think will happen to the asset markets in the fall? Nothing good.
Okay.
So this is how the thing. This is the point.
Why do you say fall? I mean, and fall's not that far away. It's less than 2 months away. So you think that the summer is a window for everything to remain sanguine?
Yeah.
And what in the fall specifically, besides like, midterm elections here, what else could happen in the fall that you think is going to, accelerate this?
Well, you don't need anything else. You need just when the rates rise, the housing market is starting to crater. The consumer is starting to pull back. The artificial liquidity in the asset markets is being withdrawn to the QT programs of the Fed.
Are you sure the real estate market is cratering, or
isn't it? Was it in the housing starts was in massive decline?
Oh, okay. I'm talking about housing prices. So you're talking about construction.
Construction, that this will usually precede the actual market. So I don't see how the housing prices can stay this low for long. People are
the bulls will say lack of supply.
Yeah, that's true. But if you notice the initial jobless claims, they were like 500,000. If I saw it correctly, it was a massive increase.
Yeah.
So people now the kind of job market is turning too. The recession is coming from every single angle of the U.S. economy. I say everybody will notice within the next 2 months, 3 months. So you have the recession coming, you have the liquidity drawing, you have the interest rate, and the inflation still keeps going. There is no way the U.S. economy can the asset markets can sustain this. So we are currently estimating a market crash in October or November.
Okay.
Crash of
that's a seasonal period where those events have historically happened. So
it's in the same rates as in 1929 or something like that.
Yeah, it's from what level in the S&Ps? Because right now they don't look that bad, do they?
No. But this was as expected. There would be some rally, a big bear market rally. And I think we're now in the middle of it. It may even last. Well, okay, GDP it's interesting to see how the markets take it, because it kind of signals that the Fed may be pausing, maybe with its interest rate.
It reinforces what people are trying to have heard yesterday.
Yeah.
Right.
It could reinforce that. That's for sure. But it's just the people tend to forget that the inflation has become rather widespread in the US. It shows in the wages and so everywhere. So, and when inflation reaches that point, it comes kind of self-fulfilling. If people have inflation expectations keep on climbing, more or less, the inflation will just feed itself, and you need to continue to raise the interest rates.
Yeah, we need a bad recession, because I think there is price gouging going on just because they can. Not everyone is raising prices because they have to, but they see it as an opportunity because people are getting used to, this doubled, this is up 50%, so why not?
And people, and it goes everywhere, like in Europe too. But one really interesting thing, and go a little bit over beyond the border of the US, is China. This is China consumer.
I saw that chart. Yeah.
What is this? I have no idea. This is like complete fall off the cliff during the last, in 2 months. It's not just this month, it's 2 months.
Yeah,
And
well, I
you know,
guess when you can't get your money out of the bank, it doesn't instill
yeah,
confidence.
that's true. And when you are locked down in Shanghai or
So
whatever.
you know what this means to me with all the stuff that's going on about Pelosi's trip and
Mhm.
Xi would lose face on this, that they have an awful lot of probably unemployed men,
Yeah.
especially with their one child policy where they can't find wives
Yeah.
to put in uniform. That's what worries me.
Yeah, that's true. But the other thing is that we have a China researcher here in Finland who's been speaking a lot about like how China has a revolution or has had as a revolution for every 70 years for a long time. So after 70 years, there's some kind of a revolution. And the China Communist Party was set up in, I think it was 49. So they're kind of overdue a few years already.
Okay.
So
Wow.
the thing is that the China,
and people are still buying Chinese internet stocks and it's working.
Yeah, of course. And I think the tech sector is looking rather good in China, actually. But it's the whole other economy.
Yeah, because they're easing.
Yeah, they're easing again. Yeah. I just, I just looked at there's been a massive increase in the social financing again, or the the financing of the Chinese economy.
Xi making an about face on trying to tear down big successful Chinese tech companies.
Well, that too, yeah. But I think there's a wider kind of clamp down going on in China just to try to it's preparation for the imminent or the recession that is inevitable in China, and they try to get the people in such a tight grip that there will not be a revolution. I think they know their history very well and what will happen, like if these men, of course the other option is to put these young men into uniforms and go fight a war outside China. That's naturally an option.
Do you think that's going to happen?
I don't know. We don't it's a China, the policy of China has been to kind of build its empire behind the scenes, through finance.
Yeah.
To the Belt and Road Initiative, and there are actually even projects here in Finland, the tunnel that should go from Helsinki to Tallinn under the Baltic Sea. And there's one option, a financial option for it, which would be based on Chinese money. So there's Chinese money everywhere, and they're trying to own the infrastructure in many places. So if they would change that to a outright war, I don't know how well that would play in the China would be an aggressor after that. It would certainly have a serious effect on these projects. So, but what I'm thinking, that if the war in Europe somehow escalates, which we of course do not want it to do, in that situation, if the kind of the world is dragged into this, fires again, if you may, then I think China might act. But before, I would consider it unlikely, because it would seriously hamper the long-term goals for China to have a bigger control of the world. But that's my take.
How long is it going to take now that the Ukrainians are even talking about a counteroffensive, and the U.S. is sending missiles that have 180-mile range to the Ukrainians for Putin to, I talked to somebody, and his philosophy, it was Harold Milgram, said that Putin escalates to de-escalate. Okay. Yeah. So, to put some fear into the hearts of people supporting Ukraine by using a tactical nuke in Ukraine.
That's we don't do such forecasts, but it's of course everything is possible. What they are doing now is that they are preventing Germany and other countries to fill up their gas storage.
Yeah.
That's what they're doing, and they are playing that. And this is like
I'm surprised they didn't wait till winter when it would even be worse.
Yeah, naturally.
More leverage.
But the thing is now that to prevent them from like filling up their strategic reserves of gas, that's the point here. They wanna stop that from happening, and that's why there are problems in the Nord Stream, for example.
Okay.
So the tanks are not full when the winter comes, and then Putin would have the full might of this energy weapon he has. And this is something that it's really strange to me, because if you, like, people are saying, oh, this is horrible that what Putin does with the energy thing, but this is something that he would naturally, of course, do as a counter sanction to everything else. This is how he has played out. Russia has played this game for a long time. This should be no surprise. And I don't think you don't, basically no time in history you could have coerced or forced Russia to do something with economic sanctions. They just don't abide by those. So what I think what we are just doing is creating very hazardous situation in Europe using non-effective sanction against a totalitarian regime. So the war is won or lost in Ukraine, not in the pipelines going from Russia to Europe. So I think this is a policy mistake to go to these heavy sanctions, because they will not help to get us into the goal of ceasefire in Ukraine. They will just create a massive, chaos and havoc in Europe in the coming winter.
Okay, and there's already some splits. Spain doesn't want to share the pain
Of course,
cutting back because they had better energy policy. And maybe this is Putin could fracture the alliance by one of the countries making a deal with him.
Yeah, for sure, he could do that. But let's remember that we have Germany and in most of Europe, we have deliberately handled Putin this weapon by doing these green policies for 30, 40 years. It's our own mistake. I don't see how we've been living next to Russia and Soviet Russia for 100 years. So we know how to play with them. Don't ever give them any clear leverage.
Yeah.
Don't do it unless you have something else to put, there should be a balance between leverages. And I cannot understand how German leaders could have been so stupid for so long that handling all the power of, many don't realize that if the gas is shut off going into Germany, the houses just don't turn gold. They have to turn down or run down complete, like industrial sectors, because they use gas so heavily. We don't have that problem in Finland, but in Germany, if there's gas shortages, they need to shut down the economy. It will be a depression, a massive one in a cold houses. It will be utter devastation of Germany in the worst case.
Okay.
So this is looking really bleak for Europe. One more thing. I'm showing Germany for now. Okay, so this is
keep cheering me up, buddy.
I will. So this is the IFO business climate survey in Germany, and as you can see, Germany is probably already in recession. The business expectation have collapsed as the business climate, and the business situation remains somewhat stable, but expectations are just falling heavily. And this is the situation in basically whole of Europe now. And when the ECB starts to raise rates in the September, it seems I don't know, the situation in Europe is so bleak. I never seen it like this. If you look forward, there's very, very narrow path going through here, which could lead to any good outcomes. So I'm fearing that we will face not just a depression in Europe, but a complete collapse of the monetary union, and that would be the biggest currency shock in the history of the world.
They have one more backstop, in my opinion, Tuomas.
Okay.
The Fed. The Fed, Bernanke said that the Fed could buy foreign securities.
Yep.
That was true. Within their purvey. Yep. And I think the Fed would come in and help the ECB. And the Fed's going to come in and help the Japanese. We can strengthen its yen and strengthen the euro.
Yeah, that's true.
There might be a central bank play in between that delays it a while. What do you think? It's
possible, but I don't. That's one thing that the first figure I mentioned about the quantity figure and quantity tightening. So what one Fed insider said that they will not sell the assets in their face value because it would create a loss.
Yeah.
And if they, continue selling these assets, there's going to be a massive loss, which have to be, written down. The thing is that the central banks are in a very tight spot now with the inflation, all the
Yeah.
bloated balance sheet. So the question is, could Fed step in? Probably yes. Would it? I don't know. And the always monetary unions flourish or break through political unity. And if that's lost, it basically every time in history, the monetary union has broken up. So it doesn't matter how much money goes in, if there's no political unity to continue, it will disintegrate. And this is a real risk within the 2 to 3 years, which should be acknowledged because it would be a massive shock.
Okay. Tuomas Malinen, everybody. And, he's been predicting what's happening here now. For the last couple of years, saw the storm coming. Now we're in the storm, and the Fed's going to see if they could put everything back in the bottle.
I don't think that's going to happen. Yeah.
Pandora's box is open, and like Stelio says, and a lot of people own gold. Don't worry about the price. You might need that insurance someday.
Yeah, that's my advice too.
Okay, and Anthony Kanakis enjoyed it. Thank you, Tuomas, for being here. Khalid enjoyed it. And there's you ruined the party that we were all having yesterday.
I tend to have that.
You could always count on Tuomas Malinen to take away the punch bowl every time I talk to him.
Yeah.
But maybe in 4 years or so, maybe we'll be celebrating. Come out the other side of this.
We will, and I will be. I promise you that I will be the first one to really tell you that this is going to turn now.
Okay. All right. Looking forward.
Looking forward
to the future. Yeah. Let's just fast forward all the way through to there.
4 years ahead, and yeah.
All right. Okay. All right, buddy. Thank you so much, Tuomas. Great talking to you. All right, everyone. That's a wrap. You could join the team in 15 minutes for the morning edge, and be grateful for today. Today is enough to worry about. Don't worry about tomorrow. Do the right things today, and tomorrow will take care of itself. And I'll see everyone. We'll wrap it up. TGIF tomorrow, and I have a new guest, and the reaction to me inviting him was pretty strong. So Orkin will be with us tomorrow. Adios, everyone. Don't just count your pips, count your blessings. Thank you, Tuomas Malinen, and I'll see you, F.A.C.E community, later. Adios. You're very welcome, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.